Emerging markets have performed largely in line with our expectations. At the beginning of the year, the markets were quite choppy and volatile. And that was really driven by US rate expectations, which, at the end of last year, were signaling 7 rate cuts. And in the first quarter of this year, we had a reversal of that as inflation was stickier. So that was a bit of a dampener on the asset class. But from then, we've had a pretty steady return from emerging markets, with the asset class up around 7% as the MSCI on the year, with a bit more out of Asia, a little bit less out of Japan, partly because of weak currency. And then we've had quite a lot of differentiation within that. The better markets have been those driven by Taiwan and Korea and technology. India has been continuing to perform well. And then the markets that have been weaker have really been those that are more sensitive to interest rates in the US, like Latin America, and also the ASEAN region, which has slightly been left behind. China has, as we expected, had a bit of a cyclical pickup after a very tough January, where the market sold off due to liquidity concerns. The government stepped in and helped out the market. That was taken by investors as a positive step. And the market had a pretty good pickup, led by earnings recovery and some signs of pickup in GDP, until about May, when the market has pulled back some. So, looking at it, a pretty decent start to the year. From a macro perspective, the overall environment is that most emerging markets have been growing. On the inflation side, inflation's been coming down and not as high as the developed world, and particularly wage inflation. And going back to a point we always make, that emerging markets weren't given fiscal help, they weren't given handouts. And so that means that the pent-up demand for labour, etc., wasn't there. And balance sheets are good. So a lot of the volatility has really been caused by politics, and a lot of the positive performance has been driven by fundamentals, earnings coming through. We've had a number of elections, and that's brought in country selectivity. It's also brought in a bit more political risk. So we started off with the election in India, where the polls were predicting Modi to win by a sort of landslide majority, but actually he had to, in the end, form a coalition government, and that caused quite a lot of volatility in the market. We then moved on to Mexico, where we were expecting Claudia to win, but not with the majority that she had. And that's now caused worries that the Moderno party will be much more left-wing. We were already talking about potential constitutional reforms for the judiciary. And that's really worried investors and seen quite a lot of weakness in all Mexican assets, but particularly the foreign exchange. And it is beginning to, people are looking at that and wondering whether the structural story of Mexico still remains. And then recently we've had the European elections, where the French right won a lot of votes, prompting a sort of general election in France. And that's really begun to, get markets worried about political risk again in Europe. And, we've seen a huge spike in the 10-year French bond versus the 10-year German bond, the Bund. And that's beginning to sort of worry investors, and also the euro as well. So increased political risk. And for us, as active specialists, we've always said that countries matter. We pick stocks, but we have to make sure we're in the right environment. And it's very important to have country specialists there. So it's been a good environment for alpha generation. The last 6 months in Japan saw continued outperformance of large cap versus small cap, just over a 20% difference. We've had value really outperforming growth, and in sort of sector-wise, financials, energy, utilities were the top performing sectors. We remain constructive for the second half of the year, really for 3 reasons. One, we've got resilient earnings growth and revisions, and that's been a real key to success of markets. The corporate sector, second point, is becoming more capital efficient, focusing more on dividend growth, buybacks, and that's actually outpacing earnings growth. And then the third is positioning. Now, global investors continue to be underweight the region, despite the ongoing corporate margin and cash flow generation changes. But so it leaves the valuations at a relatively reasonable level. China's been a challenging market this year, but it has produced some good returns. And it's very important to be focused on the right areas and to differentiate. On the retail side, particularly online retail, there was actually continued improvement. So where are we left in the stock market? The catalyst might come in July from the third plenum, where the government looks and talks about long-term economic plans. It might come from the July Politburo. But, it could be, a couple of months of sort of treading water, focusing on companies that are generating better earnings there. The other area is that we're getting a lot of Asian investors and Chinese investors focusing more on dividend stocks. So it's important to have a broad portfolio. Investors are, you can get dividends in some areas, particularly in financials, albeit in the SOEs. So you do take a little bit more risk relative to the private sector, where you're getting a higher dividend yield than bank deposit rates or the government bond rate. And so that's definitely attracting areas. So don't be too underweight, look for opportunities. We don't see the catalyst to go majorly overweight, and we're just really waiting to see how the policy measures that have been put in place really feed into the economy. But I think the focus will be on growth in the economy and focusing on poverty. My belief is that the government think that the best way of dealing with the rural area is not handouts. So we won't see physical handouts that will benefit consumption. We'll see more investment there to make things more efficient in agriculture. But I think we'll see a continuation or an acceleration of urbanization. And so, where it looks from the consumer, yes, there will be better opportunities in consumption, but we have to still be quite selective there. Some of the consumer stocks did very well after the election, but they're quite low earnings companies and quite expensive. I think the longer term structural story in Brazil is digitalization and e-commerce. As the population gets wealthier, and the concept of leapfrogging is very important in emerging markets, and particularly in Brazil. You're seeing companies win market share off, particularly from on the digital side of the incumbents. But I probably think that if I was to pick one sector for recovery, it would actually be the financial sector, because these the larger banks in Brazil are incredibly well run. They've gone through many difficult periods over the years, and now they're in an environment which is much better medium term, and they should benefit and produce good products. I think the election has caused some concerns that the government will interfere in the structure of society and the constitution, and I think it will take time for the market to understand the objectives of the government. And we still have a number of months before the presidential change, and so I think at the moment the structural story is on hold. We also have an election coming up, and former President Trump has been quite vocal about Mexico and the border. There is a pretty clear consensus in the US on either party that China is and trade is an issue, and we don't know how, and tariffs have been talked about, particularly from the Trump side, so we don't know how Mexico gets affected by that. And so in the longer run, the geographic position Mexico to the US is, and the amount of Mexicans abroad and remittances coming back is very, very positive. But on the other hand, we have these short-term issues, the government, what's going to happen between US and Mexican relations, and that sort of China trade issue that I'd be a bit more cautious of. In summary, we've got more upside in emerging markets, probably more driven by North Asia, more driven by earnings, more driven by the continuation of the AI theme widening out and really becoming, into orders, and benefiting from, with semiconductors benefiting, energy benefiting, other supply chains benefiting, PCs, benefiting, and then potentially smartphones benefiting. And also, good value in areas like Korea. I think the Indian story will continue to progress well, very based on earnings, probably more selective, given that valuations in some areas are quite expensive. And, China probably marks time. We're waiting for a catalyst, but, not a reason to take too much money off the table. I expect most of the returns will be made between now and the election. Then there will be a pause, maybe a pullback, given the political risk, depending on how the election's going. And then probably after the election, you'll get continuation of rates coming down, if they cut in September, and then more fiscal spend. And I think the fiscal spend in the US and the liquidity is what's driving the main emerging markets. 2024 has really shown that there are good opportunities in emerging markets. The pickup in growth from COVID, the potential for interest rate cuts later on in the year, this cyclical pickup in China that presented a very good opportunity for returns, though has faded a little bit. It really has been a very good year for active investors, and a very important year, because we pick stocks, we get on the ground, we understand the environment, but we also use country selection as a sort of risk control or for opportunities. And I think that is becoming, with all the elections, much, much more important. And so, it's a really positive reason to support active investing.